Welcome back to Yahoo Finance. I'm Brian Cheung here live on site at the Atlanta Fed's Financial Markets Conference in beautiful Amelia Island, and I'm here with Cleveland Fed President Loretta Mester. President Mester, it's great to see you, and also in person for the first time.
Exactly. Thank you. Thanks for having me on.
So nice to be here in beautiful Florida. I wanted to kick off this conversation just about Fed policy. Obviously, the big move happening last week with the Federal Reserve raising interest rates by 50 basis points. In your view, what's the next steps for the Fed?
Well, we have to get inflation under control, and that means moving the interest rate up. We have to move it up at a pace that will get that inflation under control. And by under control, I mean turning down, right? So looking at the monthly numbers and seeing that it's actually moving back down. And that'll be a challenge, no doubt, because there's a lot of things that are affecting inflation now on the supply side that aren't really affected by monetary policy, but we're really committed to be doing what we need to do with our policy tools to get demand better in line with that constrained supply and bringing inflationary pressures down.
And what underscores the need to move is the fact that we got an interest rate bump in a size that we haven't seen since May of 2000. Wondering if you feel that more outsized bumps would be needed. Is it on the table for a 75 basis point hike in the future?
Well, there's always something on the table, right? And the chair in the press conference said that he was comfortable with, moving another couple of meetings at 50. I'm certainly comfortable with that. I think we're going to have to be very careful of evaluating whether we're actually seeing that inflation move down. So we'll do the next couple of meetings. If things stay the way they're looking now, I think 50 at the next two meetings makes perfect sense. We're going to have to then evaluate whether we either have to speed that up if we don't see inflation moving back down, or if we see demand coming down faster than we expect it to, we might be able to go a little slower. But we've got to be committed to moving those inflation numbers down.
And there is kind of a lag effect to monetary policy, right? So it's not necessarily the case that you're going to see the impact of the 50 basis point increase last week immediately. So I guess in your view, we're still seeing inflation numbers come in high. We're getting another print on the consumer price index tomorrow. When would you expect to see the impact of these Fed hikes on inflation?
Yeah, well, this is the thing. I'm going to need to see compelling evidence that inflation is moving back down. I know there were a lot of reports in the press with the last inflation report that, oh, wow, it moved a little bit down. That's not compelling evidence to me. I don't want to move this too quickly off of this upward path. We need to get monetary policy in a more neutral stance, and then we have to evaluate how much further beyond that is going to be needed to move that inflation needle down. And it's going to be challenging, no doubt, because there are things going on both the supply side and the demand side, but the risks to inflation remaining high get even more risky as we keep going because of inflation expectations. So it's really important that we're committed to doing what we need to do.
And you mentioned neutral for our viewers. That's kind of an estimate of where the Fed might need to get interest rates to on the short term end, where it's neither stimulative nor restrictive to monetary policy. What is your estimate for what that is right now? The current target range is between 75 basis points and 100 basis points on the short-term rate. What's your estimate for how the Fed needs to get
So on a nominal basis, I've been saying around 2.5 is what I write into that SEP. But again, we may have to go above that if we want to get inflation down, and we are committed to getting inflation down. So again, we don't have to make that determination today, but that upward path and, my own SEP, I think we're going to have to go beyond neutral to actually rein in inflation. But I'm open to looking at how things evolve over the second half of this year and into next year to be able to sort of make a more precise estimate of what that will look like.
And I guess how far you might have to go above neutral is a bit of a precarious situation because you also don't want to tilt the economy into a recession. What do you see as the risk of recession right now, especially one that might be induced from this tightening policy?
I mean, there's no doubt that the challenge for the Fed is a large one, right? I think things will be bumpy. We've seen that in financial markets now as financial markets are adjusting. It may very well be that the unemployment rate will have to move up a little bit. We may get another quarter of, negative or slow growth, but that's going to have to happen if we want to get inflation back down. So I'm comfortable with that. I don't think what we're planning to do with monetary policy, at least in my base case, is going to push the economy into a downturn that's a sort of a staying downturn. We're aiming to get inflation down and sustain conditions for an expansion. And I don't really see it as a trade-off, really, because I really fundamentally believe that if we don't get back to price stability, we're not going to have sustainably healthy labor markets in the future.
And I want to get back on labor markets in a second, but I mean, you mentioned an interesting point. We could see another quarter of negative GDP, given the fact that we already had a negative surprise on Q1 GDP. 2 quarters back to back might constitute a recession in some definitions. I know we're in a room full of economists. They will all tell you that there are a lot of caveats to the 2 quarters of back-to-back negative growth for classifying something as a recession. So is that not the best metric for determining what would be a hard landing from the Fed's perspective?
Yeah, I mean, I don't look at it as like 2 consecutive, although you're right, that's kind of a rule of thumb. If actually you look at the underlying data in the first quarter, if you looked at both consumer spending and business spending, there's a lot of positive momentum there, right? The things that held back first quarter were trade, government spending, and that inventory correction a little bit, because inventories were built up so much in the fourth quarter. So if you look at that report and look under the hood of it, there's a lot of still positive momentum in demand. And that's why it's important for the Fed to be raising rates, right? We're trying to bring demand into better balance with that constrained supply. And that constrained supply, given what's going on in China with the zero COVID policy, and Ukraine, the war in Ukraine, which is terrible, those things have the potential of being upside risk to inflation, even if they pose some downside risk to growth.
Mm-hmm. So on the point of, I guess, assessing what could be, the impact of higher rates, do you also expect the unemployment rate to go up, given, if there is going to be this pullback in demand that's induced by higher borrowing costs? Is that going to hurt the labor market?
Well, we might see, a couple of months of that going back up. But again, I don't think that's going to be sustained, right? The labor markets now are in a position where there's so many more openings than people looking for positions. And so it's out of balance. So what we're doing at the Fed is trying to rebalance the economy. And there's just excess demand in both product markets and in labor markets, and we can push that down. Yes, there could be a case where the unemployment rate goes up for a couple months. There could be a case of another negative quarter of GDP growth, because it is, there's a lot of things moving at the same time. But our intention is to get inflation under control and to have a sustainable expansion be the outcome.
So let's talk about financial conditions right now. Things are volatile. We've seen a lot of red across equity markets in the past few trading sessions over the last few months, really. Are financial conditions as tight as you'd like them to be through these hikes?
Well, we're trying to raise the short end, our policy rate. And then, of course, how does that affect the economy? It affects it through financial market changes. And so what we're seeing is our moves, coupled with a lot of other things going on in the global economy, affecting financial markets. But the intention is to tighten financial conditions to get that inflation moving back down. We don't look at day-to-day changes in the financial markets and having that be sort of our driving force. We're really focused on our dual mandate goals of price stability and maximum employment.
Were you surprised to see financial conditions actually loosen in the initial response to the announcement last Wednesday and the press conference?
So I never really can predict how it's going to come out on that first day. I think what I like to look at is, okay, after the market absorbs, right, the actions and the signaling from the words in the statement, how do they settle out? And, this is just a very uncomfortable position, right, in terms of the volatility in the markets, et cetera. But it's a necessary situation that we have to go through in order to get those inflation numbers down.
And almost forgot to talk about the balance sheet, of course, a big topic. The announcement last week that process is going to begin June 1st to let some assets roll off of the Fed's holdings. When it comes to that process, it seems like there could be some flexibility in the future if needed. Would you see a situation where the Fed might want to actively sell some of its holdings to maybe shrink it at a faster rate than was charted out last week?
Yeah, I actually think we need to consider selling some of the MBS at some point during the process, because one of our principles is to get our portfolio to be primary treasuries. And the reason that's important is because we don't want to be influencing, credit markets. And so, I think that's something we should consider. And if you looked at the minutes to the March meeting, our March FOMC meeting, we actually said that there seemed to be general agreement on the committee that we should be looking at that in the future.
Is there a size that you would like to get the balance sheet back to? I mean, 4.5 was kind of where it was before the pandemic, ballooned to almost 9 trillion. Is there kind of I mean, that I guess it's reserves that are going to be kind of the target or the guiding path, but
exactly, that's going to come in future as we get closer to it, and as the Fed announced, right? We'll be ratcheting down and sort of going to a glide path, but we don't know that until we get closer as we kind of monitor conditions. And we're in an ample reserves regime, and we're going to make sure that we're holding enough reserves to be in that regime, to stay in that regime, but not overly large on the balance sheet. And so we'll know more as we get that. It's going to depend on the bank's demand for reserves and the distribution of reserves across financial institutions, and that'll determine that.
And then last question before I let you go and enjoy the beautiful sun here in Florida. There was a financial stability report that came out yesterday. Just wondering kind of how you're viewing overall financial stability conditions. What's interesting is that through the volatility, and the report didn't really necessarily touch on specifically this, but the broad issue of stablecoins and them perhaps being subject to runs. We saw one small stablecoin, Luna and Terra, kind of have issues over the past few days. Is this something that presents a financial stability concern in your view, from the central bank's view?
Yeah, I think we have to be looking at the longer run underlying structures of some of the markets. Stablecoins, one of them. I think the Treasury market, our experience at the beginning of the pandemic, really underscored that there's some structural issues there. Money market mutual funds, again. And those are the kinds of things that I think we all need to be working on. And it's not just one entity. It's not just the Fed. It's not just Treasury. It's a large group of regulators and overseers to really make sure that we have resilient financial markets, right? It's not about getting rid of all volatility. It's making sure that institutions and participants are resilient to shocks that can come from anywhere.
All right. Well, Cleveland Fed President Loretta Mester live here at the Financial Markets Conference in Amelia Island, Florida. Thanks so much for joining us. We really appreciate it.
Thank you very much.